We need to talk about the rules of the game. You know, the ones I mean.
Hmm.
That sort of unwritten social contract that says if you wake up early, you put in your 40 hours, you don't spend money on, frivolous things, you do everything right.
Right.
You get to have a decent life, not a mansion, not a private jet, but a life where the math just, it works.
Stability. That was the promise. You trade your labor for stability.
Exactly. But for millions of people right now, that trade isn't happening. They are holding up their end of the bargain, working harder than ever, actually. But the stability, it just isn't there.
Yeah.
We're looking at a stack of sources today centered around this one report called Nation Under Strain, and it tries to explain why so many Americans feel like they're on a treadmill that's slowly ramping up in speed while also, increasing the incline.
And it's so important to clarify right at the top that we aren't talking about unemployment here. This isn't a deep dive into joblessness.
Yeah.
This is about the working poor, or maybe even more accurately, the working worried.
The Paycheck Paradox. I saw that term in the source.
It's a fitting term, isn't it? It describes a situation where the macroeconomic indicators, the big numbers the government releases, they all say go.
Green lights everywhere.
But the microeconomic reality, the kitchen table math, it says stop.
So let's start right there. Because if you turn on the news, you hear the economy is, quote, resilient. Unemployment is low, wages have technically risen.
Right, technically.
And people are still spending. So why does that feel like gaslighting to the average person?
It feels like that because of what we can call the illusion of doing fine, there's this fundamental disconnect between an economist's spreadsheet and a real person's bank account.
Okay.
An economist is looking at aggregate data. They see that wages went up, say, 4 or 5%. On a graph, that looks like a win.
But the person who got that 5% raise doesn't live on a graph. They live in a grocery store.
Precisely. And this is where we hit what the source calls the percentage problem. This is the math that is it's quietly crushing people.
Walk me through it.
Okay, so if your income goes up by 4%, but your rent jumps 15%,
Yeah.
your grocery bill goes up 20%, and your car insurance spikes by 30%.
You haven't stayed the same.
You have taken a massive pay cut in terms of your actual purchasing power.
It's that difference between the nominal wage, the number on your check, and the real wage, what that check can actually buy you.
Correct. And for decades, there's been this divergence. Productivity has skyrocketed. I mean, American workers are incredibly efficient. They produce more value per hour than almost anyone in history.
Yeah.
But real wages just haven't kept up with that productivity.
Yeah.
They've stayed relatively flat, while the cost of all the must-haves has just exploded.
Must-haves. I want to drill down on that because the source makes a really clear distinction between, say, lifestyle creep, buying nicer things, and what it's on the cost of living stack.
Yes.
We are not talking about people buying too many lattes here.
We absolutely are not. That is, frankly, a lazy argument that ignores the data. The cost of living stack refers to the cumulative effect of rising prices on things you cannot avoid.
Essentials.
Exactly. The source describes it as a slow compression. It's not a sudden crash. It's just the walls closing in inch by inch, year by year. And the heaviest wall right now is housing.
Let's talk about housing, because it feels like this has shifted from just a basic expense into some kind of financial black hole.
Housing is transformed from shelter into a financial weight. And the source breaks this down into two distinct nightmares, one for renters and a totally different one for owners.
Okay, renters first. It used to be that if you couldn't afford a city, you'd move to the suburbs or a cheaper state.
That escape valve is closing. We're seeing rent increases that completely outpace local wages, and not just in New York or San Francisco.
No, this is everywhere.
This is happening in the Midwest, in the South, in places that were always pitched as affordable. When your rent jumps 20% in a year in a place like Boise or Knoxville, wages just can't catch up. There's really nowhere left to hide.
And then you have the homeowners, the people who achieved the American dream. But the source brings up something called the lock-in effect. This was fascinating to me.
It's a golden cage. It really is. So if you bought a home or refinanced back in 2020 or 2021, you might have a 3% mortgage rate.
Unbelievably cheap money.
Right. But now rates are significantly higher. So if you need to sell that house, maybe for a better job or because your family is growing, you have to trade that 3% rate for a 7% rate.
And the math on that is just brutal.
It's devastating. For the exact same size loan, your monthly payment could double. So what happens? People don't move. They're locked in.
Wow.
And that kills labor mobility.
Yeah.
People can't chase better jobs. And it keeps the housing inventory artificially low, which of course keeps prices high for everyone else.
Yeah. So housing takes this huge bite out of the paycheck, but then you've got the unavoidable costs. The source really highlights two that stood out: groceries and insurance.
Groceries are the most visible pain point, right?
Yeah.
Because you feel it every single week. The source talks about shrinkflation. You're paying the same price for a box of cereal that's 15% smaller.
It's a self-tax.
It is. But what's maybe more concerning is the erosion of the trade-down option.
Right, the idea that if the name brands get too expensive, you can just buy the store brand.
Exactly. But the data shows that store brand prices have been rising aggressively, narrowing that gap. The cheap option just isn't that cheap anymore. The checkout line has become this weekly stress test where you just watch the total climb and wonder if you forgot how to count.
And then there's insurance. This one, to me, is scarier because it feels inescapable.
It's what economists call inelastic. You cannot legally drive a car without auto insurance. You generally can't hold a mortgage without home insurance. You are a captive audience.
And the costs are just spiking.
Way, way past inflation.
So why is that? I mean, is it just corporate greed or is there something else going on?
It's complex. With auto insurance, part of it is technology.
Hmm.
A fender bender used to cost $500 to fix with a hammer and some paint.
Right.
Now bumpers have sensors and cameras and all this tech. That same fender bender now costs $3,000 to fix and recalibrate. But for home insurance, the big driver is climate risk.
So the weather is literally changing our economy.
It absolutely is. Insurers are basically data companies. They look at the probability of wildfires, of hurricanes, of floods, and they're just saying the risk is too high.
Wow.
In some states, premiums are doubling. In other states, insurers are pulling out entirely, leaving homeowners completely exposed or paying these exorbitant rates just to stay covered.
You've got housing, groceries, insurance, all climbing. And this brings us to this idea of redefining class. The source argues we need to stop defining middle class just by income.
Yes. We're obsessed with income brackets.
Yeah.
You know, if you make $80,000 a year, you are middle class. But the source argues that being middle class is actually a feeling.
A feeling.
It's a state of predictability.
Predictability. I like that word.
It means you know what your expenses are going to be. You can plan for the future. An emergency like a broken water heater is an annoyance, not a full-blown catastrophe.
And that predictability has been hollowed out.
Completely. We're now seeing the rise of what the source calls the financially fragile worker.
Who are these people?
They're teachers, they're nurses, mid-level managers, even some tech workers. On paper, they earn good money. They have the trappings of the middle class, you know, the car, the iPhone, the nice clothes, but they have no liquidity.
They're cash poor.
They're running on fumes. That cost of living stack eats up almost 100% of their take-home pay. Their emergency funds are thin, or they just don't exist.
And the source mentioned that credit cards are playing a different role now. It's not just about buying a big TV for the Super Bowl anymore.
No. Credit card debt is increasingly being used to bridge the gap for essentials. People are putting groceries and gas on credit, not because they want the points, but because the checking account is empty 3 days before payday.
Oh, wow.
And that creates a cycle of debt that's incredibly hard to break because it's being used to survive, not to splurge.
So it's a safety net that's made of high-interest debt?
Which is no safety net at all. It's a trap. And this constant financial tightrope walking, it leads to the next major theme in the source: pressure migration.
We touched on this with housing, but this sounds like it goes deeper. I mean, Americans have always moved. It's part of our DNA. We moved west for gold, north for industry.
But those were moves for opportunity. You moved to get a better job, a higher wage. Now people are changing zip codes for survival.
For cost avoidance.
They're just fleeing the expensive places. They're looking for places with less financial friction, lower taxes, lower rent. But there's a trade-off. They're often accepting lower wages or fewer public services in return. They're basically downsizing their entire environment to fit their budget.
But what happens to the places they move to? I've heard this from friends in smaller cities. They say, all these people moved here, and now I can't afford to live in my own hometown.
That is the spread of pressure. When higher earners flee those coastal cities, they bring their purchasing power with them to these smaller markets. They drive up demand for housing, which drives up prices.
So the inflation gets exported.
Exactly. The safe haven quickly becomes just as unaffordable as the place they left.
And meanwhile, the cities they left behind are suffering.
It's a hollowing out. When the middle class leaves a city, the tax base shrinks. Small businesses lose foot traffic. Public transit loses riders. It can create a doom loop where the city has to cut services or raise taxes on the people who stayed, which just increases the pressure for them to leave too.
It seems like a system where the pressure just moves around, but it never actually dissipates. And I want to pivot to the psychological impact of all this, because you can't live like this, constantly calculating, constantly worrying, without it doing something to your head.
The source calls this the death of planning. And this, to me, is maybe the most profound cultural shift of all.
Unpack that. The death of planning.
Well, think about the traditional American life cycle. In your 30s, you're supposed to be planning 10, 20 years out. You're thinking about college funds for kids, retirement, paying off the mortgage.
Yeah.
But long-term planning requires confidence. It requires a margin of error.
You need to know that the floor isn't going to just fall out from under you.
Exactly. And if you're in survival mode, managing week to week, you cannot plan 10 years ahead.
Yeah.
You're planning 6 months ahead. Maybe. It forces people to become short-term thinkers, not because they want to be, but because they have to be.
And this leads to what the source calls downsizing the dream.
We're seeing this quiet recalibration of what a successful life even looks like. It involves smaller homes, or maybe no home ownership at all. It involves delaying having children or having fewer children simply because the math of childcare doesn't work.
Or living with roommates well into your 30s and 40s.
Multi-generational living is making a huge comeback. And again, this isn't necessarily a cultural preference for family closeness. It is financial armor. Sharing a roof is one of the few ways to beat the modern housing market.
There's also a lot of resentment brewing, isn't there? Specifically around timing. The source talks about lock-in resentment.
This creates a quiet, invisible division in society. Imagine two colleagues sitting next to each other, same job title, same salary. Person A bought their house 5 years ago. Person B is trying to buy one now.
Person A has a $1,500 mortgage. Person B is looking at $3,500 for the same house.
Correct. So person A is building equity, they're taking vacations, maybe saving for retirement. Person B is scraping by, feeling poor, despite having the exact same income. Their lives are radically different, based purely on the luck of when they entered the market.
That has to erode your trust in the system. If hard work matters less than timing, why work hard?
That's the danger. When success feels arbitrary, like it's a lottery, rather than a ladder you can climb, social cohesion starts to break down. You start to resent the system, and maybe you start to resent your neighbors too.
So if we pull back and look at the big picture here, the source suggests the central question for many Americans has changed. It used to be, how do I get ahead?
Ambition, growth, upward mobility. That was the whole idea.
And now?
Now the question is, how do I stay secure? It's a defensive mindset. We're not trying to win the game anymore. We're just trying not to lose. We're looking for a floor that won't collapse.
And the source is very clear that we need to view this structurally. This isn't about people forgetting how to budget.
You cannot budget your way out of a structural realignment of costs. If rent, healthcare, and education have all tripled while wages have only grown incrementally, that is a math problem. It's not a behavioral problem.
It mentions the economy isn't failing loudly, it's squeezing quietly.
That's the slow compression again. There's no single event, no Black Tuesday stock market crash that you can point to. It's just that every year you get a little bit less for your money. It's the slow erosion of the standard of living.
And that's so confusing for people. They keep waiting for the big crash to explain why they feel so broke.
But the crash never comes, just the squeeze.
So as we wrap this up, the source leaves us with a really provocative thought about the social contract. If the deal was work hard, get stability, and that deal is off the table, what are we all doing?
That really is the question of our time. If that margin that made life enjoyable, that breathing room is gone, are we just working to keep the machinery running? Are we working to live, or are we just surviving to work?
It's a heavy question, but I do think for anyone listening, there's some validation in this deep dive.
I really hope so.
If you're sitting there doing the math and it is not adding up, you're not crazy. You aren't bad with money.
No.
The ground under you has actually shifted.
The data supports the feeling. The anxiety is rational. You're reacting correctly to a new and very difficult economic environment.
And understanding that it's a systemic issue is the first step, right? You can't solve a problem you don't really understand.
Absolutely. It shifts the focus from self-blame to asking bigger questions about policy, about housing supply, about wage growth.
That's where we'll leave it for this deep dive. It's a sobering look at the Paycheck Paradox, but I think an essential one if we want to understand the mood of the country.
Agreed. It's the real story behind the headlines.
Thanks for listening. We'll catch you on the next deep dive.
Take care.